Hello.
Okay.
Hello, everybody. In this interview, we're going to be interviewing Jason Kelly. He is a multi-novelist. Been writing a lot of different books on investing for the past few decades from what I've seen. Hi, Jason. You want to say anything to the audience?
Hi, yes, it's good to be with you. I'm glad to be going live overseas to Texas.
Yep, and you're all the way from Japan, right?
Yeah, that's right.
Nighttime here is early in the morning there.
Yes, it is. It's funny how you can get used to something like that, but you really do.
Why did you decide to live in Japan? I was curious about that.
I came here on a book tour in 1999, and it was just the most unusual trip I'd ever been on. The publisher took great care of me, and it was a culture so foreign to me. Canada foreign or Mexico foreign. It was just dark side of the moon foreign, and I wanted to get my arms around that culture and come to know it better. So I arranged to move here for a year, I thought, and that was 18 years ago.
Oh wow, that's very cool. I'm a New Yorker but moved down to Texas because I like the music and it's a little cheaper down here, but a little warm, 106 degrees today. So not
Is it
the
really?
coldest temperature.
Wow.
Yeah. Jason Kelly has been a multiple novelist. If you go to jasonkelly.com, you'll see all the books he's written. He's written The 3% Signal, the investing technique that'll change your life. Also wrote The Neatest Little Guide to Stock Market Investing. Financially Stupid People Are Everywhere. Don't be one of them. That's a fun title. You want to
Yes.
describe that one a little bit?
Yeah, that was a look after the subprime mortgage crash at just how many of the household problems and even national problems economically are from people making the same stupid mistakes again and again. And even the subprime mortgage crash, the main theme of that, what kicked off that book, was that banks were blamed for extending predatory loans to people. But if people were financially smarter, they wouldn't take predatory loans. And so I approach it from that angle, that if we could better educate the rank and file of America, we would avoid a lot of even our national financial calamities.
Oh, yeah, interesting. Also, a lot of my subscribers to my channel and viewers here are pretty much beginners. You know, they might just dabble in investing a little bit, or a lot of them are teachers that just go through their pension. They think that's enough. And then they start to realize it may not quite be the best way to go. Sounds like your Neatest Little Guide to Stock Market Investing would be probably a good intro to investing. You want to discuss that one a little bit?
Yes, it's an excellent intro to the topic. I wrote it for friends and family. That the entire Neatest Little Guide series had as its target audience my friends and family who just wanted to understand the topic better. And that gave me the background for financially stupid people, is that I ran into financial illiteracy. Financially stupid is a kind of harsh but attention-getting way to put it. But I wanted to at least make my own circle of people better able to plan for their financial future. And I realized when looking at the topic that it wasn't as complicated as banks and brokers and financial planners were making it out to be. And just like other complex topics in life, you could reduce it down to the essence. And if you followed the wisdom contained within that essence, you'd get 90% of the benefits without having to pay anybody to manage your money for you. And I just worked on distilling that wisdom into a style that was easy for people to digest, and I hope even fun at times, because achieving financial freedom is pretty fun.
Oh yeah, definitely is. I recently wrote an ebook on how to teach your children how to invest, save, and spend, and I'm getting a lot of good feedback as well. We both have very similar professions in that regard, trying to help out others with investing.
Yeah, that's right. I think the friends and family audience is a wonderful one, because it doesn't take too many people before you've kind of covered the spectrum of the different personality types that are available in society. And so if you can get your own smaller circle of people up to speed, there's a good chance the material will work for a broader audience as well.
Yeah. So today I want to focus a bit more about, I think your most recent book was the 3%, 3% Signal Investing Technique that will change your life.
Yes.
So just a side note, when I was looking through my COVID-19 waiting at home for months, I was like, let me check the library, the online versions. And I saw 3% signal. I'm like, that sounds pretty interesting because I've read many different finance books, but this one caught my eye. I'm like, what's this 3% about? Um, can you just briefly describe to the audience, how does the 3% rule work? When I try to teach to my kids, or my audience, I want to try to make it so that a 5-year-old might know it. Maybe we could go up to around 7-year-old, like my daughter. So can you describe
Okay,
just a general overview of the 3% signal?
sure. The essential ingredient of the stock market, the top characteristic, is volatility. Prices fluctuate, prices change, it's unpredictable, and we can't call where the market's going to go, and nobody can. Despite the media showmanship of creating a spectacle of what this person thinks is going to happen compared with what that person thinks is going to happen, the plain fact is that nobody knows what's going to happen. And so the foundational question of the 3% signal plan is, can we beat the market without ever giving any consideration to where it's going to go? And the answer is yes. The way this plan works is by looking at the fluctuation of the market and deciding on a quarterly basis whether it has gone above or below a point where we should either take profits off or add more money to it because it's lagging behind. And the mechanism for this is simple. The market rises over time. It fluctuates, but it rises like this over time, rising twice as often as it falls. If we divide this up into a quarterly pace and we try to get 3% growth from our stock fund on a quarterly pace, then all we have to do at the end of the quarter is look at whether our balance grew more than 3% or less than 3%. And 3% per quarter, if you take it over a whole year, it's actually not 3 times 4 to get 12%. It turns into 12.6% because of compounding. And that's about 20% more than the historical return of the S&P 500. Let's just say the broad stock market, which is a very good outperformance. That's the reason for 3%. It's enough more to be meaningful to us, but not so much more that we're demanding too much from the market's historical momentum. So here's how that looks on a quarterly basis. We've got the stock market rising like this, and we have our stock fund there. As market prices are moving, if our fund, let's say this here, my hand here up in front of an angle is representing a 3% growth pace per quarter, okay? And then we have the value of our fund fluctuating like this along that line. When it's above the 3% pace, we sell this difference. Let me turn my hand. We sell that difference. So if we're up this high, we're going to sell this much to get ourselves back down to that growth pace. And then if in a later quarter we come in below it, we're going to buy up this difference in order to get up to that line. So when you work through that conceptually, this is forcing you to buy low and sell high. And it's doing it without you having to choose whether it's high or low or how high or low it is, because notice in that same framework that the higher it is, the more we will sell, the lower it is, the more we will buy. And that one little function there, that the more it deviates from that pace, the more we react to it. That's what gives this plan an edge over simple dollar cost averaging, which for your newcomer listeners, that's simply sending in the same amount of money on the same time frame regardless, like $100 a month, $500 a quarter, something like that, which is a perfectly reasonable plan because it automatically buys more shares when prices are lower and fewer shares when they are higher. But this plan, the 3% signal plan I described, will buy even more when prices are low and sell even more when prices are high. That's the dynamic in a nutshell. And the beauty of it is that everything driving the plan is price change and math. That's it. We don't need to care what applied the price pressure. Why did prices go up? Why did prices go down? We don't need to care about that. We simply, at the end of each quarter, look at how far our plan is away from that 3% signal pace and then react accordingly, as I just described. And that may not be easy enough for a 5 or 7-year-old, but I think adults can see that this is a smart way to react. It's a totally rational way to react. And I think especially you as a scientist would be able to see that's far preferable than trying to guess which pundit of the moment happens to be correct.
Yeah, a lot of people might be super into investing. They're reading all these advanced topics, but then they just forget the very simple rule: buy low, sell high. That's how you make
Yes,
money. And
yes,
never
it's
want to forget it.
true.
Yep.
It's true. And I find a lot more wisdom, a lot more calm and comfort comes from this than may seem evident at that first blush with it. From my experience talking with people who've changed from the usual stock picking, trying to time the market method to this signal plan, their reaction is always, well, is now the right time to get in? Is now the right time to start this plan? And I'm not really sure about this because it does heavily weight stocks.
Yeah.
And then, so they start gradually and they see how it goes. And usually 3 or 4 quarters later, the reaction is, how in the world did I go this long in life without this?
Hmm.
Because a common refrain is, it's such a breath of fresh air to look at the financial media and see the current debate over where stocks are going next, and to realize they don't know and I don't know, and I don't have to care anymore.
Yeah. Um, you pretty much answered it already, but why do you feel systematic approach is preferred, like you say, instead of choosing your own stocks, like, oh, the new hot stock of the week, or warrants and specs and all this advanced stuff that people do?
Sure, it's a valid question because the reason I think stocks are especially challenging to people is that the type of mind that is attracted to the stock market is an intelligent one. Dummies don't take an interest in stocks. They're complicated. And so what happens is we bring intelligent minds to this market and we expose them to a moving price average, and then suggest that there's a reason prices are moving and that it's our job to figure out that reason. And so all of our brilliant brains start analyzing this, and there's no end to the factors we can analyze. Is the Fed's latest move good or bad? Which presidential candidate is better for stocks? What's going on in China and how does that affect my portfolio? There is truly no end to these questions, and there's not much of an end to the answers to those questions. And so there's this kind of analysis paralysis that sets in to the intelligent mind. So paradoxically, one of the best things we can do as an intelligent person in the market is to disconnect our brain and our thinking feature from how our money reacts to the market. Because the intelligent person has the exact same 50% mistake rate that the non-intelligent person has in the market. That's a true number. Comes out to almost exactly coin toss odds when you tabulate the historical accuracy of various pundits calling the market. And just disclaimer, I participated in one of those studies back when I was picking stocks. I started out in this business that way, picking and choosing stocks, before I realized, only half the things that I care about matter, and I don't know when.
Yeah. It's like those monkeys that
So
throw
that
the
was quite
darts
an
at
eye
the,
opener.
yeah, like the monkeys that throw the darts in the newspaper, and it happens to pick a stock and they beat all these super intelligent people, right?
Oh, it's true. It's true. But yet the media continues. I've got a story for you, Lance, little sidebar here. I used to go on TV, such as CNN Money and other types of financial programs in America. And I'll never forget this eye opener. I come into the green room. That's where you wait before you go on in front of camera. And there was another guy in there, two other guys, actually. I was talking about a different topic. These guys were the stock market pundits. One of them was there to explain why prices went up that day. The other one was there to explain why prices went down that day. And the network brings two of them in every time, because no matter how the market ends, they've got a guy ready to tell you why.
That's awesome. Yep.
That's pretty sobering.
Yeah. Be ready for both sides, right? For
Yeah.
your stock allocation, it sounds like you're interested in a small cap blend fund. You want to describe why you pick a small cap blend over large cap blend or value and whatnot?
You bet. When you think back to, again, the process of that plan and how we are going to react to how our price line moves around that signal indicator each quarter, when you consider that the plan sells a surplus and buys a shortfall, then it's not much of a leap to understand that the bigger the surpluses and the bigger the shortfalls, the more profit we can extract from this process of automatically buying low and selling high. Therefore, a wider fluctuating price line is to our advantage. And small cap stocks have higher volatility. Their price line fluctuates more than the S&P 500 or other type of broader market indexes. And that's why that's the fuel to the plan for the original 3% signal plan. And I later realized in further research beyond the 3% signal book that if more volatility produces more profit, then wouldn't even more volatility exaggerate that in the right direction? And the answer is yes. And that's why in my letter, I run 2 additional permutations, which are the 6 sig as opposed to 3 sig. We have the 3% signal plan, the 6% signal plan, and actually the 9% signal plan. Now, in order to get those higher goals, right, appreciating at a 6% and a 9% rate, we have to introduce leverage. And as luck would have it, we have plenty of leverage funds to choose these days. And so you're correct that the small cap blend market, and the one I choose is the S&P small cap 600, that index of small company stocks, both growth and value, is great for the 3% signal. For the 6% signal, I use a 2x leveraged mid-cap fund. And for the 9% signal, a 3x leveraged NASDAQ 100 fund. And all that's really happening is that we're adding more volatility. Just what we talked about a moment ago, that if surpluses and shortfalls this big can produce a lot of profit, maybe this big can produce more, and this big can produce even more. That's all we're doing. We're expanding that range that we're going to use.
All right, great. How easy is it to implement your plan? If there's people that want to just occasionally look at the market and not really have to worry about this day in, day out, like how simple is it to actually do?
It's very easy. First of all, the pace is easy, just once a quarter, so every 3 months. That's appealing to busy people. And most individual investors are not doing it full time. They're not managing family fortunes. They're packing a 401k or a 403b, IRA, something like that. And it's something they do on the side from the kitchen table, not from a boardroom table at a corporation, you know. And because of that, these plans are appealing. It's once a quarter. The math is very simple. It's easy to do on a calculator, but I also offer a spreadsheet and then also an online calculator where you fill out a form. You just say what your balance was a quarter ago, what it is now. You know, you put in the factors like the stock fund price now, and at the end, the calculator spits out a series of, well, only 2 steps to take: buy or sell this many stock fund shares and buy or sell this many bond fund shares as a result. And that's it. It's very easy. It's even easy for people that don't like doing that kind of math. You can't get away from the math entirely, but it's not complicated stuff. Just how far are we above where we're supposed to be, and therefore how much should we sell, that kind of thing, and once a quarter.
Yep. When a few teachers in my school, and I've actually just helped someone from Oklahoma recently, they're brand new to investing, they don't know what to do. I usually start off with, well, let's just do target retirement fund for whatever year you want to retire. That's usually, I think, good enough for a large majority of people. What do you think are your benefits to your plan compared to that, similarities and differences between them?
Sure. First of all, I would agree. I don't think you're misleading anybody by saying just invest in a target retirement fund, maximize your contribution to that, and look forward to 30 years from now. There's nothing wrong with that, and I want to put that right up there. There's also nothing wrong with dollar cost averaging. If somebody has automated sending $300 a month to a stock fund in their retirement plan, that is legitimate. All of these approaches we're talking about, the target retirement fund you mentioned, dollar cost averaging, and then also these signal plans I'm talking about, all of these are far superior than shooting from the hip to get the next great stock. That stock picking is the worst thing you can do, day trading being the worst among that subset of investing. But how the SIG plan compares to a target date retirement fund, the SIG plan should perform better. And specifically the 6% and 9% ones should perform a lot better. The reason is that the target date funds they're more balanced. And my research has shown that this idea that we diversify to prevent all of our eggs being in one basket in order to get safety, that's actually not the goal. I hinted at that earlier by saying more volatility is what allows us to get more profit out of the market. There is a caveat here, Lance, I want to make clear to the newcomers. You can find extremely volatile individual stocks, but they're not guaranteed to recover from a crash. Whereas a broad index will always recover. And sometimes somebody will jump in here and say, well, what if it doesn't? What if it's the big one and never recovers? I would submit, just we're at that point, you're in a realm of what if an asteroid strikes? What if the oceans rise? You know,
Worry about your life before that.
yeah, for all practical purposes, index funds always recover. They certainly always have. And we just have to proceed on the assumption that they will. And we cannot proceed with that confidence in an individual stock. They can go bankrupt. That's important to understand, that the reason we can have confidence to buy after a big crash is we're talking about index funds and they will recover. So the target date fund will have a more balanced mixture. It'll heavily weight stocks in the younger years, and then later it'll back out that allocation, as you know. But the beginner might not know that. But the balance is going to produce less of a return than this pure stock exposure and pure reaction to the volatility of that stock exposure. I should say, in all honesty, not in all timeframes. There are timeframes where a target date fund will win. I don't think we can say always too much of anything in investing, but generally in the main, over time, the performance should be better in these SIG plans than in a target date retirement fund. And I would say particularly so with the higher growth plans, 6 and 9 SIG.
Okay, great. I think you did mention it earlier, but are you able to do this plan in a regular brokerage, a IRA, even a Roth IRA?
Yes, in fact, those are perfect. IRAs and Roth IRAs are generally run at big brokerage houses like Schwab, Fidelity, Vanguard, TD Ameritrade, those kind of places. And the beauty of those types of accounts is that they're wide open to many different types of funds. So you can use the exact funds I use in the letter, which, for example, is IJR. That's a symbol of the ETF that I like, that invests in the S&P Small Cap 600. Most brokerage accounts, IRAs, Roth IRAs, will have that fund available in there. And if they don't have that one, they'll have something that's a nice substitute. Schwab has a great small cap fund, so does Vanguard. And so you can find a way to run this plan in just about any of those retirement accounts. In a company-sponsored plan, like a 401k or a 403b, those types, you generally have a smaller subset of funds you can choose from, but they almost always include a small or even medium cap stock fund, and that's the one you want. The simple process for choosing what you want: bond fund, just the cheapest general bond fund that's there, works for the plan, and then the cheapest small cap stock fund is the one you want for the 3 SIG plan.
Mm-hmm. Yeah. Speaking about fees, a lot of the new investing people that I talk to, they're like, oh, well, that's only 0.5% annual fee instead of like 0.1%. Like, that doesn't sound like a big deal. But then when you actually look at the numbers off many decades, that could be a huge amount of money. So that's a good idea to go with the cheapest that you can. I always recommend, oh yeah, this is the cheapest fee you have. This one will suit what you need, and go with that, right?
Yeah, that's exactly the way to do it. And interestingly, Morningstar did a study on the relationship of expense ratios to raw performance. And it turns out there's a bit of a correlation there, that the cheaper a fund is, the better its raw performance tends to be anyway. And there's some debate over why that would be. It might be simply that the lower the expense ratio, the less money there is to pay these brilliant people to run the fund. So you have less people involved. So you're going to index more, and that's going to produce higher performance than these people meddling.
Right. In current interest rate environments, that's insanely low. Have you ever put any consideration in other avenues for the bond part of the portfolio? Maybe gold or treasury inflated protected securities and whatnot?
I have looked at that. I can't find anything that works. It's not worth deviating from the plan. And I would say the reason for that is that these plans move money back and forth between the stock and bond side on a quarterly basis, which allows the fluctuation of both sides to sometimes work in our favor and sometimes against. Mm-hmm. That's comforting in the sense that it negates any need to figure out when the bond market is going to crash, what rates are going to do. It takes that pressure away from the investor. I like that factor. The other part of it, though, is that the bond side is really just to protect buying power for the stock side. All of the growth happens on the stock side. And so I'm very uninterested in any kind of safe side fund that fluctuates too much. It's supposed to pretty much just keep money there, and any extra profit that flows into that side is just gravy. It's not supposed to be a meaningful driver of performance. So for the purposes of these plans, and that side just being a repository for buying power, the general bond funds are about perfect.
Okay. All right, great. That was all the questions that I had, and for a few of my viewers, they were part of that as well. Do you have any questions for me? Or?
Yeah. How many typical investment questions do you get from your colleagues on a regular basis?
The
I mean, is it weekly that you're approached, or?
most common one was like, I think I need to start investing. I haven't saved anything yet. Could you help me with that? And then a lot of it's just the teaching plan of like, this is what a stock is. This is what a bond is. You know,
Yeah.
you're loaning money instead of you're a part owner of the company. And it's like, this is why you want to possibly invest in this over this. And this is why fees are important. Really straightforward things. But yeah, a lot of the teachers that I work with, they're thinking about it. They might have some money on the sidelines, but they're too scared to implement it. And then obviously with the whole COVID-19 conditions in the last few months, there are people like, oh, is it time to get out now, or is it time to put back in? And then I'm like, you have many decades down the road. You can't be too worried about that stuff. So yeah, very straightforward questions. But I definitely like talking to people like you and others in communities that definitely have a lot of knowledge in this regard.
You bet. And I would say for that general crowd, you're steering people the right way toward target retirement funds. If they don't have an interest in this, if they know that they're supposed to do something, but that's the last they want to do is just check the boxes to automate it and then stop paying attention, there's nothing wrong with target date retirement funds for that. But I would say the prime audience for this kind of approach we're talking about is somebody who wants a little more involvement. They don't want their life to be taken over by stock market headlines, but they want a little more involvement as a price to pay to get significantly higher performance, most likely. And there are a lot of people that fit that, and it's gratifying for them to have something to do that's not going to totally derail their future.
All right, so sounds great. So again, this was Jason Kelly. You could reach him at jasonkelly.com. Also has a YouTube channel. I'll leave in the description below with further information. And it was great talking to you, Jason.
Great talking to you, Lance. Thanks for having me.
All right, have a good day.
Bye-bye.